Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thanks for tuning in to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from Silicon Valley corporate headquarters of Wilson Investment Properties, the sponsor of Real Estate Radio Power Investing. I'm Tom K. Wilson, your host for this weekly radio show on multifamily and commercial investing and syndications. If you can't make the live show, you can catch our podcast on tomwilsonproperties.com. You can also go to baycom.club for information about our free monthly education meetup venue on commercial and multifamily investing with world-class speakers. And you can go to tomwilsonproperties.com also to sign up for our newsletter on economics and real estate investing. Also, you can, by signing up, you will get access to the syndications that Wilson Investment Properties offers every few weeks that are only available to those mostly who are have a relationship with us through signing up through our newsletter or contacting us. And we always welcome your questions and requests. I look forward to talking to you at any time. Go on that website for a lot of education information on real estate investing. Look at different examples of products, FAQ, all the podcasts that we have, and live events and webinars and so forth that we offer to help you with education. This is being broadcast in February of 2019, and next week we have a Baycom event on February 28th at 6 p.m. at the Trianon Theater in San Jose, and it's going to be featuring guests who are experts in capital gains deferment, including 1031, Delaware Statutory Trust, Deferred Sales Trust, monetary installment sale. And we're going to have on today as our guest is Tom Bottenberg, who is an expert in 1031 exchanges. And Tom, welcome to the program.
Thank you. Appreciate it.
So, Tom, give us a little bit about your background. How long you've been involved in 1031 exchange business?
Well, I've probably been involved with 1031 longer than I'd like to admit. I actually got my start in 1990 working with a tax law firm in Oakland, and that's kind of where I kind of learned the business and was involved in some of the marketing and learned the processing as I went along. Eventually, I left there in 1994, founded my own firm, was there through 2007, and then continued with some consulting for banks, doing 1031 exchanges inside the bank per se. And then a couple of years ago, I left and I joined up with IPX 1031 Exchange Services, which is the captive exchange company for Fidelity National Financial, which is the large title insurer that owns Chicago Title and Fidelity Title and a number of others.
Surely.
So that's kind of my background in 1031, how I got to here.
Okay, all right. So the 1031 business, there have been a lot of accommodators have come and gone. During the last crash and one before that, of course, when equity dries up and people don't have anything to exchange out of, it's pretty tough on the accommodator business. So I would guess in the last crash you lost a lot of competition.
We did. I was fortunate because at that point in time I was kind of teed up to consult with banks, and so we were working on other stuff, and our approach at that time had been using 1031 to source relationships with high net worth exchangers, and so we kind of continued in other veins until the market kind of came back. But we did lose quite a few accommodators along the way, although IPX has always kind of been a leader in the space, and it's mostly due to the fact that they're a subsidiary of a Fortune 300 company, and they kind of dominate the space in terms of volume by virtue of the captive relationship of all the title companies that generate in-house business.
Can you, I didn't ask you ahead of time to prepare it, but do you have any feel for the volume of 1031 exchanges in the country? How that's at the
Well, I think the last survey that I saw for exchanges was the hard numbers came from 2015, when we're doing a little over 250,000 exchanges per year.
My goodness.
Since that time, the market has dramatically expanded. So it's slowed slightly here lately, but not too much. So I would assume that we're probably at a pace nationally of doing probably a little over 300,000 1031 exchanges a year, based upon the Form 8824 that exchangers file with their tax return. It kind of memorializes their 1031 exchange. So it's still a substantial volume. It's still a big part of the space.
So let's paint the big picture for our listeners. We, being in the business for so long, it's easy to take it for granted and think that everybody knows what it is. I think most real estate investors know about it or know something about it. But can you just paint the aerial view? What is a 1031? What's it for? What's its purpose? How long has it been around?
Well, the 1031 exchange has actually been around since 1921. Originally, all exchanges were done simultaneously, meaning that if you're going to sell an appreciated asset and you wanted to defer the capital gains taxes, you could do that, but you would have to buy your replacement property and close everything on the same day. And that was the status quo ante for a long, long time, until the 70s, when there was a test case, and the case was a gentleman in Oregon whose name was T.J. Starker, and T.J. Starker sold some timberland to Crown Zellerbach. And what happened is, rather than take cash, is he went ahead and took a credit on the books of Crown Zellerbach the next 5 years. When he found a property he would like, Crown Zellerbach would buy it on his behalf, deduct that from his balance, and then have it deeded to them. But you can imagine that this entire concept of a delayed exchange at that point didn't really work so well with the IRS, so they disallowed everything. But long story short, they went to tax court, and the Starkers prevailed on most of their cases, and so that created and kind of memorialized the delayed exchange concept. And so in 1984, in an effort to get their arms around it, the IRS kind of struck a compromise with what we now know as Section 1031, and that's where they actually came up with the idea where you can do an exchange of an appreciated asset and you can defer the capital gains as long as you do it all within a 180-day window, and you also identify candidate or target properties that you want to buy within the first 45 days. So the rules that we now know for 1031 in terms of the timing restraints, those were actually created and codified in 1984, and there haven't been too many changes since that time.
And so it's made it a lot more comfortable for people to move forward. It wasn't something they needed to get a comment or letter from the IRS. They already established it, so then people knew that they could do that with a much higher confidence than they could before. Right,
exactly. So the IRS codified the whole delayed exchanging concept and created a safe harbor. So as long as you're operating within the safe harbor in terms of using a qualified intermediary to hold your funds, buying like-kind property, and then doing everything within a 180-day window, and then identifying what you want to buy within 45 days, you fall within the safe harbor, and that's how people have done most of their exchanges. Probably 90% of all exchanges are of that delayed or deferred exchange type.
Before that, everyone had to show up the same title company or the same bar at the same time with their paperwork and sign everything on the same day, right, and swap it.
Exactly right. Right.
Yeah. Probably a little more exciting then.
Very exciting.
And but it's just for investment properties, right? So it's like kind, but you have to go from investment property. An investment property has to be arm's length, and it can. So talk about that a little bit.
Yeah. So one of the key requirements of 1031 exchange is that all the properties that you exchange have to be considered like kind, and the IRS looks at like kind in two forms: either held for investment, property that's held for investment, or property that's held in a productive use or trade of business. So it's either property held for investment or property held for income. Those are the defining parameters for like kind. So even a vacant lot qualifies because presumably you hold that for investment, but not necessarily for cash flow.
But you can't buy and sell from your mother, right?
Exactly right.
So it has to be arm's length, which means it can't be any close business relationship, or it can't be a family member, that sort of thing.
Exactly. Technically, you can sell to a related party, but you can't really buy from a related party.
Interesting. Okay, that part I didn't know. All right, so that gives a little introduction. Let's take a very short break here, and we'll be right back with Tom Bottenberg.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Welcome back to Real Estate Radio Power Investing. This is Tom K. Wilson, your host, and we have Tom Bottenberg on today, and we're talking about 1031 exchanges, how you can defer capital gains by selling a piece of real estate and exchanging it into another piece of real estate and defer the capital gains. So, Tom, let's talk a little bit about the intricacies of some of the rules, restrictions, how you go about doing a 1031 exchange. So maybe let's start off with the 45-day rule, the three different ways that you can identify product, and let's talk about that.
Sure. So as you suggested, you have a total of 180 days to complete your exchange, and that's 180 calendar days. So technically, if you started your exchange late in the year, say around Thanksgiving, it's possible that you might have to file an extension on your tax return to get the full 180 days. And that's the first main timing rule is 180 days total available in terms of your exchange period. The other key date that you need to keep in mind is within the first 45 days after you close on the property that you sold, or what is known as the relinquished property, you need to identify some key target or candidate properties in which you're interested in buying. And whatever you buy has to be something you previously identified. Now, when you identify property, the IRS has set forth two rules and one exception for identifying. It's kind of interesting that they created an exception to only two rules, but they actually did. The rule that most people use is what's known as the three property rule, meaning that you can identify up to three properties of any value. Now, there are situations, and we see this quite often in this area, where you have a highly appreciated property and maybe you wanted to exchange into more than one property. You can use what is known as the 200% rule. And the 200% rule is basically you can identify more than three properties. It's just that the total aggregate value of all the properties you've identified cannot exceed more than 200% of the value of the property you sold. So if you sell something for $500,000, you can identify more than three, you can identify more than four or five. It's just that the total aggregate value of everything you identify cannot exceed $1 million.
And how much of that do you have to close on?
You don't have to close. You can close whatever you want. It's just the identification purposes is restricted to the 200% rule.
So if you identified 10 properties and you wanted to only close on 3, and that would be okay?
Yeah, you're still okay. Still okay.
And if it didn't happen to exceed your relinquished property value, you just pay tax on the difference? Right. Okay.
And then the last rule is what's known as the 95% exception, which for all practical purposes might as well be the 100% exception, which basically means this. you can blow it on the 3-property rule by naming more than 3, and you can blow it on the 200% rule by naming more than 200%. But as long as you buy in aggregate at least 95% of the value of the properties you identified, you're still okay.
Mm-hmm. And
but it's very difficult to buy 95% of something, obviously, so that's why in practical terms it's kind of like you can identify more than 3 and more than 200% as long as you can effectively buy everything you identified.
And little did I know on my first exchange that was not a very typical thing to do. So I exchanged one house in San Jose into 13 duplexes in Texas, in Dallas. So
Exactly right. And that's, as we were referencing earlier, that's something you're seeing more and more of. People are transitioning in high growth areas from California, say, for instance, and transitioning into growth markets in the Sun Belt, especially in Texas. And so it's quite often you'll see somebody sell a single investment property or two and successfully exchange into a bunch of great replacement properties that are in a market that probably has better trending growth opportunities.
Wilson Investment Properties, for many years, was a provider of turnkey rental houses to investors from Dallas to around the country, but mostly in California. And it was not uncommon for us to get a call from an investor on the 43rd day saying that we need an exchange and need to find things to exchange into. We just found you, but we need to buy 12 properties that we know are available and are titled and that we can get hold of, and they'd say, we got it for you, and I can sympathize with your situation. I've done 40 1031 exchanges, and we're here to support you. So we did quite a few like that. Right. So that's part of the liability, is that 45 days seems like a long time, especially when you first go into contract. So you have more than 45 days because you have the contract period before you close on your relinquished property.
Clearly,
but my gosh, that timeline can get a rocket ship on it. And
identifying is clearly the toughest part in any 1031 exchange.
Yep.
Successfully identifying.
So in markets where it's a very hot seller's market, a lot of buyers, hard to close on something that or even get under contract unless you significantly overpay for it. That becomes a real challenge, and I would guess it has affected somewhat our the number of 1031s that are happening, because it's harder and harder for investors to find a replacement property in certain markets, in hot markets.
Yeah, it's made it more difficult, but that's one of the reasons why we encourage people to start looking well before your relinquished property is even closed. So if you have a little bit of flexibility on the timing of the escrow associated with your relinquished property, you want to keep that as long as you possibly can, because as you suggested, that 45-day window moves pretty quickly. Mm-hmm. But we also are starting to see people transition into more investment-grade institutional alternatives where they may be a little bit more accessible and a little easier to identify because you're going into something that is possibly professionally managed, and there's a portfolio of available properties that you can identify fairly readily. Mm-hmm. The other thing that we often see is, because it's difficult to find replacement properties, we see people doing what are known as reverse exchanges. And a reverse exchange is simply a situation where you actually buy before you sell. So if you're successful in finding a suitable replacement property, you can go ahead and buy that and then subsequently exchange out of the old property later. And
there's just a couple little tricky aspects of that. You want to talk about that?
Yeah,
I've done 3 reverses, and
yeah, the reverse is it's a little bit trickier because there are rules. For instance, you can't exchange into property you already own. So, for instance, you couldn't just buy the new property and then hopefully swap out of the old property. So, in that scenario, what we have to do is we have to create what the IRS calls an exchange accommodation title holder, and so we actually create an LLC to go on title to the new property. And typically, what happens is the exchanger has to advance the funds to buy the new property, we buy it in the name of the EAT, and that starts the 180-day window. And then later on, when you sell your old property, we retire the debt, and then we go ahead and reconcile all the math and pay you back the money that you've advanced, and then deed you the new property, or actually assign you the LLC that is the EAT.
And because it's a little more complex, it's a little more expensive exchange to do, right?
It's much more complex, and it's also much more expensive. But there are times where, through no fault of their own, maybe somebody has sold a property and their buyer has fallen out, but they're already committed to buying something else. And so in some of those kinds of situations, people don't have a choice but to do a reverse. And then there are some more sophisticated investors that think that since it's easier to find replacement property, or since it's harder to find replacement property, and it's easy to know what you want to sell if you find something, that they feel that they have more control in a reverse scenario. So some people just prefer reverses, but the logistics are a little bit more difficult.
Oh, I totally agree with that, especially if you're buying something that's hard to find. Usually the larger the property it is, or if it's in a hot market. That's definitely had a number of situations where that's what I wanted to do first, and one of the key difficulties for a lot of buyers or a lot of investors is that you've got to buy that property out of your own funds, and you got to
so you got
to put up all the money to get the thing purchased before you do the sale, which might retire that money. But it can definitely enable you to get a better quality product. And I'm a strong believer that there's a lot of people who wind up doing an exchange, and they wind up overpaying because they're in a panic to avoid using the exchange, and they wind up with a product that's not so good. So it's really key to do a reverse if you can, if it's a hard to find product, I feel, or to start as early as you can, and even before you get your relinquished property into contract, as you pointed out earlier. Okay,
right. So
go ahead.
It's hard to planning your exchange out beforehand is always helpful, and it always streamlines the process. But you can hardly spend too little time and diligence finding the right replacement property, and then finding the right replacement property logistics that will actually make your exchange work.
Boy, I sure feel that comment strongly. I totally agree from my experience. We will be back in just a moment after this short break on Real Estate Radio Power Investing with Tom Bottenberg. Stay with us on 1031 Exchanges.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Welcome back to Real Estate Radio Power Investing. I'm Tom K. Wilson, your host, and I want to let you know that we're doing a series here on deferring capital gains, and the BACOM.club, BACOM, BACOMM.CLUB, is a venue sponsored by Wilson Investment Properties that, if you happen to be listening this prior to February 28th of 2019, there's a great panel of which Tom Bottenberg, our guest today, will be on that panel, and it will be held at 6 o'clock at the Trianon Theater in downtown San Jose, and it'll be a great panel and discussion of the different techniques to defer capital gains, so you can move money from one asset to another and defer those gains. So I encourage you to go again to BACOMM.club and sign up for that. Also, that club has monthly meetings on various topics related to multifamily and commercial investing and syndications. Tom, let's continue on the discussion about 1031, the whole process. Let's tell the listeners, if they want to do that, what they need to do in preparation, wording in the contract. Can you go through a little bit of the logistics, how to find a good accommodator, what the accommodator does, so forth?
Yeah, so the logistics of doing a 1031 exchange are fairly streamlined at this point in time because it's been around long enough that it's almost become fully commoditized. But you can think in terms of the logistics kind of like this. If you want to do a 1031 exchange, the first thing you probably want to do is think of that in terms of when you're listing your property. So when you're listing your property, and then obviously subsequently when you're actually entering into a purchase and sale agreement, you probably want to memorialize your intent to do a 1031 exchange. So you should go ahead and put some exchange-oriented language in both your listing as well as your purchase and sale agreement. And even if you put something as simple and as cryptic as buyer agrees to cooperate with seller in a 1031 tax-deferred exchange, that will be great. And then the reason you want to do that is because once you get an escrow and when you're actually executing your exchange agreement, technically what happens in the exchange agreement is you're assigning your rights in that purchase and sale agreement to your qualified intermediary. And so we're going to be asking the other party, the buyer in your case of your sale, we're going to be asking them to sign the agreement. That's why we suggest you put some language ahead of time in your purchase and sale agreement as well as the listing. And then logistics-wise, it's important that you have your exchange set up before you actually close because we have to create that exchange agreement and then have that executed prior to the closing, just along with all the rest of the documents on your sale. And then what happens at that point in time is we create a trust account for your funds. The funds from the proceeds, obviously you can't touch them. That's one of the requirements of 1031. Otherwise you would have actual or constructive receipt of your funds, which would disallow your exchange. So when you actually close, the equity proceeds, rather than going to you, actually goes to a trust account at your qualified intermediary, and that's what starts your 45 and 180-day window in which you need to ID and when you need to close. And then continuing with the logistical process, once you're out looking for property, say, for instance, you found a property you'd like to buy or you need to make a deposit, your qualified intermediary should be able to make your deposit out of your 1031 funds. And then subsequently, we create another exchange agreement that ties the entire transaction together that goes to your purchase escrow. And then when that's ready to close, your qualified intermediary will wire transfer the rest of your funds, and then everything closes and you actually receive the deed to the new property. And if you wanted to have a totally tax-free transaction, I'll give you the shortcut, real simple 1031 math. This is the cheater's math that 1031 people use all the time. If you want to have a totally tax-deferred transaction, you need to do three things. You need to buy a property that is equal or greater to the net selling price of whatever you sold. Number two, you need to move all the equity from the old property to the new. And three, you need to replace your debt. So if you do those three things, you'll have a totally tax-deferred transaction. To the extent that you don't do those three things, so to the extent that you trade down in value, you don't completely replace your whole property, or you hold back some cash, or you don't necessarily replace all your debt, you will owe tax on the difference.
I think a lot of people don't realize that, yes, ideally you replace the relinquished property with a property that's equal to or greater than that value. If it's greater, of course, you got to come up with the extra dollars to support the difference. But I think a lot of people feel like if they buy something, they can't find anything they like at the same value, but it's less, it blows the whole 1031 exchange, and it does not, right? You only pay, it's just that you pay tax on the part that you didn't exchange.
So the IRS basically looks at it like this. They allow you to do a tax-deferred exchange because they obviously recognize that it's like-kind property. So you're selling an investment property and you're buying another investment property. But they figure, oh, that's just Tom Wilson moving his cost basis from one qualifying property to another. So as long as you're moving equal or greater in value, they just see it simply as you're moving your cost basis, and maybe you're trading up and you're coming up with a new adjusted basis, and then you start depreciating and everything all over again. But to the extent that you don't replace it all, then you are going to have some kind of a taxable event.
Okay. All right. That's a good perspective to help remember the whole purpose of the process. We've had seems like every year that I've been full-time investor business, 20 years now, there's always the threat that 1031 is going to go away with the new Congress or whatever. Hasn't happened. Is that because most people in Congress own real estate? What do you think, Tom?
Well, it's as you suggest. The Congress has taken a run at 1031 on numerous occasions, and they had some success this last time around. So at the beginning of last year, what they did do is they eliminated 1031 as to personal property, and so now you can only 1031 exchange real property. Prior to that, we used to do a lot of exchanges of jets and rail cars and
I didn't realize that had gone away.
Yeah. So
darn, I should
have
sold my jet last year, huh? Let's take a very short break here, and we'll be right back with Tom Bottenberg.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Welcome back to Real Estate Radio Power Investing. We have Tom Bottenberg on the program today. He's one of the panelists on the Baycom.club event at the end of February here, the 28th, in San Jose at 6 p.m. at the Trianon Theater. Go to Baycom, BACOMM.CLUB to sign up. And we're talking about the details of 1031 exchange. Conceptually, it's pretty simple. Investment property to investment property, and identify in 45 and close in 180. But there's a lot of details about it, and Tom's doing a great job of educating us about it. So, Tom, a lot of accommodators out there. What's the difference in one from another? Why should they pick your firm over another one? How does someone go about selecting a good accommodator?
Well, it's as you suggested earlier that there was a period of time where we kind of had to crash and we lost several accommodators, and the ironic aspect of the 1031 exchange industry is it's still a relatively unregulated space. So there, for instance, isn't any licensing or any particular due diligence that's required, except for in maybe 4 states. I think Nevada, Idaho, Maine. They have rules for accommodators or 1031 qualified intermediaries. But the main thing that most investors and most exchangers need to keep in mind is the safety of the funds when they're on deposit, because when you do an exchange and your funds are held by the qualified intermediary, technically those funds then belong to the intermediary. So you can imagine if something bad happens, bad things will accrue to the exchanger. And we've had actually defaults where exchangers have lost their funds but still owed the tax. So the one thing you want to do is when you're looking for a qualified intermediary, look for somebody who's established and look for somebody that can absolutely guarantee the certainty and the security of your exchange proceeds when they're on deposit. So, for instance, that's where IPX 1031 is a little bit differently, because we are a subsidiary of a Fortune 300 company. We have $100 million in bonding that protects every dollar that we hold. And then we also have $30 million in performance assurances. So we're fully bonded and insured. So you don't have to really take too much of a risk.
Let's take a short break, and we'll be back with Tom Bottenberg on a little bit more on 1031 exchange and how to select the best one. This is Tom K. Wilson, Real Estate Radio Power Investing. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Welcome back to Real Estate Radio Power Investing. We have Tom Bottenberg on the program today. He's one of the panelists on the Baycom.club event at the end of February here, the 28th, in San Jose at 6 p.m. at the Trianon Theater. Go to Baycom, BACOMM.CLUB to sign up. So if someone wants more information, Tom, how do they get hold of you?
They can go to our website at ipx1031.com, or they can give me a call. My phone number is 408-961-1324.
Well, it's been great having you on the program, and we look forward to having you on the panel next week, Tom. Thank you.
Yeah, I'm looking forward to it.
And thank you for tuning in once again to Real Estate Radio Power Investing. We're glad to have you with us, always glad to have you here. Don't forget to go to TomWilsonProperties.com, where you can get all of the podcasts that we've done for the last 6 years. You can also sign up for our weekly newsletter, which on economics and real estate investing. There's a lot of investor education information on the website, frequently asked questions, a lot of information about what is a syndication, why, how does it work, how do you invest only $50,000 and get to participate in the product and returns that normally only institutional investors and large investors get to participate in. So we encourage you to do that. Also, go to BACOM, BACOMM.club to see what our monthly events and speakers are. It meets the end of every month on Thursdays. So we encourage you to go check that education venue out as well. So thank you again for joining us and on this program about 1031 exchanges. We look forward to you tuning into the next program. And remember, the only thing that matters is what you do next.